My favorite tax credit, that's right, the one that gives you an extra benefit for saving up for retirement. Are you going to qualify this year before it changes? Guys, some big changes coming to this one, and I don't like them. I'll explain that more coming up. If you could get a tax credit for saving up for retirement, something that you were going to do anyway, saving up for your financial future, isn't that icing on the cake? That's like, yeah, the cake is good, but the icing on top of it, even better, takes a really good thing and makes it super unhealthy. No, like even better, right? For your taste buds. That's what the Retirement Savers Contribution Credit is. The Retirement Savers Credit. This is an extra tax benefit on top of the normal tax benefit that you get from saving into your 401k, your Roth IRA, your IRA, something like that. As you know, when you are funding your retirement accounts, your tax shelters, if you contribute pre-tax to your 401k or to a traditional IRA, you get a tax deduction today on your contribution. It grows tax sheltered, and then out there in the future, when you're retired and after age 59 and a half, you can withdraw those dollars, and that's when you pay tax on them at ordinary income tax rates. That's pre-tax to the 401k and traditional IRA. Or, as you know, you can do Roth to your 401k if allowed, and they all should by now, or a Roth IRA, where your contributions are after tax. You don't get a benefit today. They grow tax sheltered, and then when you withdraw those dollars after age 59 and a half and holding a Roth IRA for 5 years, all that growth comes out tax-free. That's good. Those are good features, good benefits. Getting an extra tax credit that you don't have to repay on top of that benefit, oh my goodness, if you can qualify, you need to make sure you do. Here's how it works. The Retirement Savers Credit. If your adjusted gross income is below certain thresholds, then you can get a 10% tax credit on the first $2,000 that you contribute to retirement accounts, an IRA, a 401k, a Roth IRA. You can get an extra 10% tax credit on the first $2,000 that you contribute. So $2,000 contributed to your Roth IRA gives you an extra $200 tax credit on your tax return. That's right, $200 extra in refund for contributing to the Roth, something that you normally don't get a tax benefit for today. But wait, there's more. That 10% tax credit isn't for everyone. You might, depending on your adjusted gross income, you might qualify for a 20% tax credit. That's right. If your adjusted gross income is even lower, below certain thresholds, then you get a 20% tax credit instead of a 10% on the first $2,000, which means you get a $400 tax credit on doing a $2,000 contribution to your Roth IRA, your 401k. $400. That's fantastic. But wait, there's more, right? It actually does get better. If your adjusted gross income is below even another threshold, the tax credit is 50%. Guys, I have qualified for this early in my career. We've helped others qualify for this as well, where the tax credit is 50%. For example, you contribute $2,000 to your Roth IRA and you get $1,000 tax credit on your taxes. That's right. Unbelievable. So what are those income thresholds? What are those adjusted gross income thresholds? You can see it right here. This is the tax form, the actual tax form for 2025 for this Retirement Savers Contribution Credit Form 8880. Yeah, these are low thresholds, right? So it's not that if you make a lot of money, this could be a potential for you. Yeah, it really depends. I'll tell you some things to be on the lookout for, but married filing jointly, you can qualify for the Retirement Savers Contribution Credit if your adjusted gross income is below $79,000. Head of household, you can qualify for Retirement Savers Contribution Credit if your adjusted gross income is below $59,250. And single individuals or filing separately, you can qualify for the Retirement Savers Contribution Credit if your adjusted gross income is below $39,500. So these are low thresholds, but this is a unique and extraordinary tax benefit. So what do you need to be on the lookout for? First, early in your career or late in your career, i.e. you're working part-time in retirement. Those are the seasons when you're just starting your career, you're maybe working part-time, but also in college, something like that. Or maybe at the end of your career, you've retired from your main job, you're maybe working part-time or doing some consulting income, and you've got some other resources you're living on where you're not drawing a lot out of your retirement accounts and paying taxes. Those are seasons when you might have the resources to contribute to retirement, but your adjusted gross income is low enough that all of a sudden, out of the blue, you're eligible and can qualify for these tax credits. This is likely not a tax credit that you're going to be eligible for and get year after year after year. Likely it just is a flash in the pan, and you've got to capture the opportunity when it presents itself. So that's the first thing to look out for. Second thing to look out for is one-income households. If you're married filing jointly, and one of you is working and the other one is home taking care of the kids, or the other one has already retired, one-income households, again, provide this sort of experience where your adjusted gross income might be lower than it otherwise would be. But here's the risk, and here's one of the big opportunities as well. In that scenario, if you're a one-income household but married filing jointly, it's possible there's only one of you contributing to retirement. That would be logical, right? And so the opportunity that we see for a lot of folks to optimize this credit is, oh, wait a second, only one of you is working and contributing to the 401k. We've got to find a way, even though cash flow is tight, to open up a Roth IRA for the non-working spouse and find a way to contribute $2,000 into that non-working spouse's Roth IRA or retirement account. Why? Because the tax credit is on the first $2,000 contributed to retirement accounts for both spouses, right? So it'd be $2,000 for one spouse and $2,000 for the other spouse. If you're in that 10% credit, that's $200 for each of you, $400 in tax credit. Oftentimes we see, one income household maybe making $70,000 after 401k or pre-tax 401k contributions, and that gets them down to $70,000. Well, they've been contributing 10% to retirement, so they had $7,000 going to retirement, but it was all in just one person's name, right? So the tax benefit was only on the first $2,000 for that individual. It wasn't on another $2,000 because the other spouse did not contribute any. Be on the lookout for one income households for married filing jointly, and find a way for each of you to get $2,000 at least into your retirement accounts. And then the final thing to look out for is be aware of when it may make sense to contribute pre-tax to get below the threshold so that you qualify for this benefit. And then once you qualify, shift it to after tax. So if you're in these low income bands, it may make sense to say, I would never do pre-tax. I would only do Roth because I'm in a really low tax bracket. Unless your adjusted gross income is going to be $80,000, then it might make sense to contribute pre-tax for $1,500 to get below that $79,000 level. And now you're qualify for this tax benefit. And then everything after that $1,500 deduction to get you to that level, then after that, everything goes to Roth. Optimize by being aware of when you should do pre-tax and when you should do Roth. And there is some urgency to take advantage of this tax credit. Why? Because in 2027, laws are it's supposed to change. The retirement savers tax credit is going to shift in 2027 to a retirement savers match, not a credit. I still don't know how the IRS is going to pull this off, but part of the Secure Act 2.0, Congress said, well, we've got folks that are behind with retirement, and therefore, for giving them this retirement savers credit, that boosts their refund and they go out and spend it. I know we will give them this credit by putting it into their IRA or putting it into their Roth IRA instead of giving it to them. The amounts will be the same. How you qualify will be the same. But instead of it being a tax credit, they're going to deposit it right into your IRA directly or directly into your Roth IRA. I have no idea how in the world they're going to do that. That would require that they have account numbers, that there would be this authorization through the payment system between Treasury and your brokerage account. I have no idea how they're going to pull this off. Wouldn't be surprised if they delay this rollout instead of 27 out there to some other time in the future. But to me, even though that could be a benefit, to me, this changes the whole deal. And I would want you to be on the lookout. If you could qualify in 2025 or 2026 for this tax credit before it changes, by just doing some adjustments to your tax planning, I would make sure you do so that you capture it before it changes. Work with your certified financial planner on that to do that proactive tax planning work to qualify for my favorite tax credit, the Retirement Savers Tax Credit. And if you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go on and take your next wise step in your financial life.